Brad Williams, Frugal Finance, the cross-hedge. I provided an example long ago on an incomplete cross-hedge example. This is a comprehensive review of another cross-hedge example. Might be more informative. Let me tell you what we're doing. We have the financial vice president of a large manufacturing firm has decided to issue $1 billion worth of 90-day commercial paper in 3 months. The outstanding 90-day commercial paper of the firm yields 17%, or 2% above the current 90-day T-bill rate of 15%. We have commercial paper yielding 17% on a T-bill rate of 15%. Fearing that rates might rise even higher than this, the vice president decides to hedge against the risk of increasing yields by entering the interest rate futures market. He decides to hedge the firm's commercial paper in the T-bill futures market. So we have commercial paper and T-bills. What's the biggest challenge there for leading into everything else? Are these two instruments, do they follow the same volatility? Since rates on commercial paper and T-bills tend to be highly correlated, that needs to be tested. So since one type of instrument is hedged with another, this hedge becomes a cross hedge. In general, a cross hedge occurs when the hedged and hedging instrument differ with respect to risk level, coupon maturity, or the time span covered by the instrument being hedged and the instrument deliverable against the futures contract. This means that the vast majority of all hedges in the interest rates futures market are cross hedges. The hedge contemplated by the vice president is a cross hedge because the commercial paper and the T-bill differ in risks. So the question is there a means to hedge commercial paper with commercial paper? And why not? Why is this guy hedging commercial paper with T-bill? Why is he not buying T-bills? And you're asking, well, there's a 2-point spread. These are just hypotheticals that if you're the treasurer or the CFO, or if you're someone in the finance department, you just sit there and you guys have these meetings, and these meetings go, well, we're going to hedge or we're not going to hedge, or we're going to use these tools, or we're going to swap, or there's just endless products out there. This is just a simple example, all right? So the vice president decides to take steps related to the commercial paper issuance and T-bill futures contract, making sure they align perfectly in terms of timing. To do this, they choose to sell 1,000 T-bill future contracts maturing in 3 months, coordinating the timeline with the commercial. All right, we got T-bills and commercials, and what is he doing? He's selling. What's the instrument? So what's long and short? What's he doing? Price. The transaction details are shown in table just below here, where the price is set at 960, resulting in a futures yield of 16%. Futures yield. So we have 17% on commercial paper, 15% on the T-bill. He's buying this at a discount, and I think I said zeros in the previous example, and I meant discounted price. It's worth explaining that this differs somewhat from the current 90-day T-bill, which stands at 15%. So we have 3 different yields, 17, 16, 15. During the next 3 months, there's no change in the futures yield, keeping it at 16%. As the future contract nears maturity, the spot and future rates converge. Therefore, there's no gain or loss incurred in the futures contract trade. Got that? So you can see all the moving parts here. You got the spot price, you got the futures price, you got T-bills, we have commercial paper. So there's a lot of things moving around in the background. So the financial vice president plans to sell 90-day commercial paper. He expected a yield of 17%, which should net the firm $957 million. So the vice president sells 1,000 T-bill future contracts mature in 3 months with a futures yield of 16%, a futures price per contract of $960,000, and a futures price of $960 million. So now, 3 months later, the spot commercial price is now 18%. The usual 2% above the T-bill rate. Consequently, the sale of the $1 billion of commercial paper nets $955, not the expected $957 million. Opportunity loss. The T-bill futures contract is about to mature, so the T-bill futures rate is equal to spot rate equals 16%. The future price is $960 per contract, so there is no gain or loss. The 90-day commercial paper spot rate, now here we are at the commercial paper, in the cash market at the end of the hedging period has become 18%, not 17%. That was the original 90-day spot rate at the initiation date of the hedge. Since the vice president thought he was locking in 17% spot rate, he expected to receive $957.5 million for the commercial paper issue. Commercial paper rate at the time of issue is 18%, so the firm receives only $955 million. This appears to be a loss in the cash market of $2.5 million. However, this is only appearance. Vice president may have thought he was locking in the prevailing spot rate of 17% at the time the hedge was initiated, but such a belief was unwarranted. By hedging the issuance of the commercial paper, vice president should have expected to lock in the 3-month forward rate for the 90-day commercial paper. Figure 5.3 clarifies this relationship by presenting yield curves for T-bills and commercial paper based on bank discount yield. The yield curves are consistent with the data of the preceding discussion. At the outset of the hedge, the 90-day spot T-bill rate is 15%, and the commercial paper rate equals 17%. The 180-day spot rate are 0.152, 7.171174 for T-bills and commercial papers, respectively. The profile of the yield curve provides enough information to calculate the forward and future rates for the time span covering the period from day 90 to day 180. For the 90-day T-bill with a bank discount rate of 0.15, 15%, the price of $1 million face value T-bills is $9,625. The growth in this investment over the 90-day horizon is 1.03896 equals $1 million divided by 9,625. For the 180 T-bill with a bank discount rate of 15.2%, the price is 924, and the growth would be 1.082251. Futures yield to cover from day 90 to day 180 has been specified to be 16%, a price of 960, and an implied growth of 1.041667. The values are mutually consistent because 1.0225 is equal to 1.03896 times 1.0416. We've gone through this a couple different times. Similarly, for the 90-day commercial paper with a rate of 17%, the price of $1 million face value instrument would be 9,575, with a growth of 104 equals $1 million divided by 957. For the 180 commercial paper, the discount rate is 0.171174. This implies a price of 914,413 and a growth rate of 1.093 equals $1 million divided by 914. These commercial paper rates of 17 for the 90-day and the 17,114 180-day paper implies a forward bank discount rate of 18%. From here, you have 18% for commercial paper for the period from 90 to 180 days. For the 90-day paper at a bank discount rate of 18%, the price of $1 million instrument is $955, which will grow by a factor of 1.47120 over its life. These values are mutually consistent. So here we have all this information and our tools and then our forward. Now it's just a matter of calculating, hypothetically, what's going to happen here. These forward rates evaluate at time 0 are the expected future bank discount rates to prevail on 3-month T-bills in commercial paper beginning in 3 months. Consequently, the implied yield on the commercial paper of this example is 18, not the 17 that the vice president attempted to lock in. Now, it is possible to understand exactly why the vice president was unable to lock in 17%, even though it was the spot rate prevailing at the time the hedge was initiated. The reason is simple. For the time period over which the commercial paper was to be issued, from 3 to 6 months into the future, the market believed that the 90-day commercial paper rate would be 18% in 3 months. The futures price and yield reflects this belief. Although the vice president desired 17% rate, the market's expected rate was 18%. And by entering the futures contract, the vice president locked in the 18% rate. Therefore, the opportunity loss of table 515 is only apparent. The vice president's expectation issuing the commercial paper at 17% was completely unwarranted. Instead, the vice president should have expected to issue commercial paper at the market's expected bank discount rate of 18%. Then you would have expected to net $955 for the firm, which is exactly what happened in this example. Brad Williams, Frugal Finance. See you soon.